of a comeback in this last recession, but I'm hoping that'll be temporary. But for an open economy with a great deal of cross-border trade and investment and a great deal of tourism, it's not worth it. And even in the current environment, having a pegged exchange rate but having the option to devalue, right, not being committed in a more ironclad way, I think carries a negative value. Right? The ironclad commitment puts a valuable constraint on monetary policy. In the absence of that constraint, monetary policy can go off track, and people who worry about it going off track are going to be reluctant to invest in the economy. So it may scare away investors. It's hard to say how many because we don't see the hotels that haven't been built. I think the benefits of membership in a common currency area are important and positive, and especially so for a small trade-dependent country. But I think we don't need to approach the question of currency choice from the top down, looking at it like we're macroeconomic planners and sort of weighing up costs and benefits for society as a whole. Let's let people make their own choices. Let's think about the preferences of the people who use money. Let's think about consumer sovereignty, applying to money as much as to other goods. And the fact that there can be a difference between what consumers want and what their governments want is especially dramatic in Latin American countries where, despite it being illegal, people have dollarized themselves. Right? They've kept their savings in dollars and even conducted, gone to the market with US dollars because the local currency was losing value so rapidly. So I think that when you take into account people's desire for a credible currency, pinning down inflation, it makes a stronger case for having an exchange rate rule than is recognized in the standard theory. So I'm suggesting that money users normally want a monetary unit, one in which they can conduct a wide range of desired trades at low cost, right? So they don't have to expend a lot of resources changing money every time they want to make a trade. And secondly, a currency that has a stable purchasing power, a low inflation rate. And both of these are important. I mean, when Latin Americans flee the peso, they flee into the US dollar. They don't flee into the Swiss franc. Right? Even though the Swiss franc has a better inflation track record than the US dollar, it's not as transactable. Right? There's not as much trade between El Salvador and Switzerland as there is between El Salvador and the United States. The second criterion, that you want a stable purchasing power or low inflation, and that could be more important than lowering your transaction costs, is exemplified by Switzerland itself. Right? Switzerland has refused to join the European Central Bank. They haven't even joined the EU because they don't see that it's going to give them a better quality currency. Right? They would rather have a currency, rather have a monetary policy decisions being made by Swiss central bankers than by a committee of people from all kinds of countries whose commitment to low inflation hasn't been as staunch. I put it that way because I don't want to, particularly single out Greece or Spain, countries in Europe with higher inflation. Oops. So if that's the way you read consumer preferences, and if, like me, you're skeptical about the likelihood of successfully using activist monetary policy to dampen rather than amplify business cycles, and of course nobody wants to amplify business cycles, it's just a problem that it's too hard to get it right. I think in the United States we've seen, we thought the business cycle was dead, or some people did, until we had this last asset bubble where clearly the Federal Reserve was stepping on the accelerator, holding interest rates too low for too long. That was an activist monetary policy. That was not dictated by any rule. That was Alan Greenspan thinking he knew better. If those are how we want to, if those are the consumer preferences we want to serve, then basically there are two questions we want to ask about any candidate monetary arrangement. One, how low are its transaction costs? And secondly, how credible is its commitment to low inflation? So those, I think, are the two most important tests. So let's think about the floating Bahamian currency again. I think both of these tests work against a floating currency. It makes it more expensive to transact with your trading partners, because now you go into an exchange market with a floating exchange rate. It creates a bigger spread between getting in and getting out. And you have a less credible commitment to low inflation. Studies that have been done looking across Latin American countries, contrasting those that had a peg to the US dollar and those that floated, found that the ones with pegs did better. They had lower inflation and they have deeper financial markets. That is, people are more willing to make long-term loans than they are in a regime where there's no constraint on monetary policy. The experience in Eastern Europe has been similar. I mentioned some of the Baltic republics before. So when the Soviet Union broke up and Estonia and Lithuania reestablished their independence, the first thing they said was, well, to be a full-fledged nation, we need our own currency. So I mentioned Kurt Schuller. He actually went to Lithuania with a couple of other economists, and they advised, really, you should set up a currency board. But the Lithuanians were not immediately persuaded, because the one economist in Lithuania with a PhD in economics said, no, bad idea, we need a central bank. See if you can guess who became the head of the central bank. The same economist, but it didn't work out so well. Right? They had high and rising inflation, and their exchange rate against all their trading partners were fluctuating wildly. They finally said, not worth it, and they belatedly adopted the suggestion to have a currency board. Initially it was linked to the US dollar, but they eventually switched it to the euro because that was the more natural choice. That's their bigger trading market. The currency in Estonia is also linked to the euro. So they decided that the prestige of having a floating currency, I'm not quite sure why it's prestigious, but it wasn't worth the instability. In the European Central Bank, in the European Monetary Union, you see a sort of similar thing, that it was originally 13, now 16 countries have decided to give up having their own national monetary policy in order to enjoy the lower transaction costs of having a common currency. So you don't have to change money when you cross from France into Germany anymore. So if you had a floating Bahamian currency, it would require more money changing costs in trading with the United States. And it would produce a less credible commitment to low inflation. Now, that's not necessarily true. I mean, you could recreate the Swiss central bank here. It's just very unlikely. No other nation's been able to do it. So let's rule out floating and move on to the choice between the status quo and hardening the peg. You might think that the current system gives you the best of both worlds. You have a pegged exchange rate, but you've got the freedom of independent national monetary policy. But the point I'm trying to make is these are fundamentally in conflict. You weaken the commitment to the fixed exchange rate if you try to run an independent national monetary policy. So in a sense, you're shooting yourself in the foot by creating the perception that the chances of devaluation are greater than they would be if you had a firmer commitment. And this is a lesson that economists eventually learned from the breakdown of the Bretton Woods system, right, where they tried to pursue inconsistent objectives, and learned again in the devaluation crises in Southeast Asia in 1997. So where's the inconsistency? Well, in the Bretton Woods system, right, where countries had pegged exchange rates to the US dollar, the idea was to restore fixed exchange rates and the benefits of low transaction costs and stable investment environment that had been associated with the classical gold standard. So it was designed to recreate those benefits of the classical gold standard, but at the same time, since the world had now learned Keynesian economics, give the central bank more leeway to stimulate the economy when necessary. And John Maynard Keynes himself was